History doesn't repeat itself, but it often rhymes. This saying rings ominously true in today's financial markets. Corporate insider activities are now reflecting alarming patterns reminiscent of past catastrophes. As corporate insiders dump stocks, the warning signals echo the historic crashes of 1929, 2000, and 2008. Decisive action is crucial now to protect your wealth from the impending storm. This report explores these trends and their dire implications. Imagine you're on a serene beach on a sunny day, the waves gently lapping at the shore. You're at peace, basking in the tranquility, unaware of the lurking danger. Suddenly the ocean starts to pull back unusually far, a subtle warning of a coming tsunami. At first it seems like an interesting phenomenon, but it quietly signals an impending disaster. By the time you recognize the threat, it's almost too late to take cover. Welcome, my friends, to the complex, turbulent world of investing. We're on the brink of a financial tsunami, and the retreating tide is our silent alarm. Corporate insiders are selling off their stocks at an alarming rate, a historical harbinger of market turbulence. Picture this: in boardrooms across the globe, high-ranking executives make nuanced decisions, trading millions of dollars of company shares. These maneuvers, often unnoticed by the public, form a sophisticated dance, a dance of risk and reward. But what happens when the music changes and the dance floor clears out? When insiders start swiftly exiting the stage, leaving us to grapple with the overwhelming fallout? Today, we'll dissect the chilling phenomenon known as the Great Risk Transfer, a scenario where those in the know offload their risk onto unsuspecting retail investors. This stealthy exodus isn't just a potential market signal, it's a glaring red light that has flashed ominously before some of the most devastating financial tsunamis in history. Think 1929, 2000, and 2008. Let's break down some eye-opening insider sell-offs over the last 3 months. Nvidia insiders have sold 3 million shares while purchasing just 54,000. Microsoft insiders followed suit, selling 430,000 shares and buying only 15,000. Apple insiders stand out, selling 404,000 shares with 0 buys. Meta's insiders sold 406,000 shares and bought just 40,000. History has shown us this pattern before. Major market crashes have left a trail of devastation, often hitting retail investors the hardest while corporate insiders quietly escape unscathed. Take the Great Depression of 1929. Stock prices soared on waves of speculation and overconfidence. Insiders sold their shares just in time, cashing in on the boom. When the market finally crashed, ordinary investors were left to pick up the pieces. Fast forward to Black Monday in 1987. The Dow Jones plummeted by 22.6% in a single day. With few regulations in place, insiders managed to bail out early, leaving retail investors drowning in losses. The dot-com bubble of 2000 saw a rush to invest in internet companies. Executives and early investors offloaded their shares during IPOs, cashing in on the hype. As the bubble burst, everyday investors were left holding overinflated stocks. Then came the 2008 financial crisis, triggered by a collapsing housing market. Financial executives sold off their investments, reaping profits while the public remained in the dark about the unfolding disaster. Even the COVID-19 crash in March 2020 saw accusations of insiders selling shares based on non-public pandemic information. Despite efforts to regulate, each of these catastrophic events highlights a troubling pattern. Insiders often have the upper hand, leaving retail investors to suffer the consequences. The alarming truth behind insider stock sales. In recent months, we've witnessed an unsettling trend. Leading tech company insiders are offloading their stocks at record levels. Here's why this matters to you. Central banks hoarding gold. In an unprecedented move, central banks are purchasing gold at the fastest rate in 55 years. This trend signals growing wariness and mistrust in fiat currencies, pointing toward significant global economic uncertainty. U.S. national debt explosion. The U.S. national debt now stands at an eye-watering $35 trillion, with an alarming $1 trillion being added roughly every 100 days. This trajectory showcases an unsustainable fiscal policy and potential financial chaos ahead. Rising de-dollarization efforts. A growing number of countries are reducing their reliance on the U.S. dollar as the world's reserve currency, a move that will destabilize global financial structures and reduce the dollar's dominance. Escalating foreign disposals of U.S. assets. Foreign countries are dumping U.S. dollars and U.S. debt securities at an accelerating rate. reflecting diminishing confidence in the stability of U.S. economic policies. Increasing vulnerabilities in the banking sector are eerily similar to pre-2008 conditions, potentially foreshadowing another banking crisis. Commercial real estate default surge. Rising defaults in the commercial real estate sector signal deepening economic troubles and potential fallout in related industries. Rising insolvency in bonds and corporate debt. The growing number of insolvent bonds and mounting levels of zombie corporation debt further strain the global financial system, indicating systemic weaknesses. Implementation of central bank digital currencies, CBDCs. As countries worldwide jump on the CBDC bandwagon, concerns grow about the devaluation of the US dollar, along with significant privacy and security implications. The occurrence of massive layoffs across various sectors underscores the fragile state of the economy and signals contraction. These mounting macroeconomic strains amplify the ominous signals from insider stock selling, suggesting insiders foresee imminent financial distress. Gold. During the 2008 financial crisis, gold prices soared from around $800 per ounce at the start of 2008 to over $1,900 per ounce by the peak in 2011. This represents a substantial gain of approximately 137%, highlighting gold's role as a safe haven asset in times of economic turmoil. Silver, similarly, silver skyrocketed from about $11 per ounce to nearly $49 per ounce over the same period, a staggering increase of around 345%. Gold and silver have consistently demonstrated their value as robust safeguards against financial turmoil. Their historical performance underscores their reliability during periods of economic uncertainty, offering a compelling argument for investing in physical metals. These assets provide not only a hedge against market volatility and inflation, but also a tangible, time-tested means of preserving wealth. Investing in physical gold and silver is more than a strategic move. It's a commitment to financial security in an unpredictable world. The great risk transfer is a recurring nightmare in the financial world. Throughout history, corporate insiders have dumped their stocks, pocketing profits, while retail investors are left to bear the brunt of catastrophic losses. In 1929, before the Great Depression, insiders sold off their shares just in time, leaving the average investor in financial ruin. The dot-com bubble of 2000 saw tech executives cash out before the crash, leading to massive losses for everyday investors. The 2008 financial crisis repeated the same story, with insiders bailing out before the housing market collapsed. Today, we are witnessing the same ominous signals. Corporate insiders at leading tech companies like Nvidia, Microsoft, Apple, and Meta are offloading their stocks at an alarming rate. This massive sell-off is a glaring red flag, signaling an impending financial storm. The historical echoes are deafening. Insiders protect their wealth, while the risk is transferred to unsuspecting retail investors. The financial tide is receding, and a tsunami of economic instability is on the horizon. Massive layoffs, skyrocketing national debt, increasing banking vulnerabilities, and global de-dollarization are all compounding the risk. The rise of central bank digital currencies, CBDCs, further threatens the value of fiat currencies. In times of such uncertainty, physical gold and silver stand as your ultimate safe haven. Unlike paper assets, which can vanish in a market crash, gold and silver have historically preserved value and provided robust protection against financial turmoil. You don't have to be a sheep, blindly following the herd into financial ruin. Be a lion. Change the narrative. Protect, preserve, and privatize your wealth with physical metals. The great risk transfer is happening again, and the time to act is now. Don't be left holding worthless stock certificates while insiders walk away with the profits. Safeguard your financial future with gold and silver before the storm hits. For over 40 years, Swiss America has been dedicated to helping clients secure their financial future with physical gold and silver. We understand the importance of protecting and preserving wealth in times of economic uncertainty. Contact us today at 1-800-289-2646 to learn more about how you can safeguard your assets. No obligation, just education. We're here to help you achieve a portfolio that benefits you and your family's needs. Visit us at or call 1-800-289-2646 to speak with a representative.